The standard Medicare Part B premium in 2026 is $202.90 a month. But depending on your income, that number can climb all the way to $689.90. And here's the part that catches people completely off guard. Social Security determines that surcharge based on your income from 2 years prior, so your 2026 Medicare bill is based on what you earned in 2024. If your income has dropped since then, you may be overpaying right now and have no idea. That's just one of the things I'm going to walk you through today, and it's not even the one that surprises people the most. The Social Security Administration does not apply the same rules to everyone. Depending on the year you were born, your full retirement age is different, your claiming options are different, and the mistakes that can permanently reduce your monthly check are different. Right now, in 2026, there are people in every one of these groups who are either receiving less than they're entitled to or are about to make a decision they cannot undo, simply because nobody sat down and explained what the rules actually are for their specific situation. Today, I'm going to do exactly that. There are 3 separate birth windows inside the pre-1966 group, and each one carries its own rules, its own risks, and its own deadline pressure. I'll walk through all 3, one at a time. Find the window that matches when you were born, and pay close attention once we get there, because this is the part that actually affects your money. And I'll tell you right now, the thing I'm saving for the last window is the one that has been genuinely blindsiding people in 2026. So stay with me through all 3. Before we get into it, if you're not subscribed to this channel, please do that right now and turn on the bell. Here's why it genuinely matters. Social Security changes its numbers every single year. Full retirement age brackets, Medicare surcharges, earnings limits, overpayment policies, and when those things change, the SSA does not send you a personal explanation in plain English. They update the policy and assume you already know. What this channel does is close that gap before the deadline passes and before the mistake is already locked in. The people who are subscribed here find out in time. The ones who aren't tend to find out after the wrong decision, after the deadline, after the money is already gone. Hit subscribe, turn on the bell, and let's get into it. Window 1. Born between 1943 and 1954. You're somewhere between 72 and 83 years old right now, and you've likely been collecting Social Security for well over a decade, which is exactly why most people in this group assume there's nothing left worth checking. That assumption is quietly costing some of you real money every single month. The first thing to look at is whether you're actually collecting the right benefit. A significant number of widows and widowers in this age range are collecting their own retirement benefit when they would receive more on their late spouse's record. Monthly survivor benefits can pay a spouse or child significantly more over time, sometimes reaching 100% of what the deceased worker would have collected in retirement. And in a lot of cases, that number is substantially higher than what the surviving spouse receives on their own record. If you lost a spouse and have never specifically asked SSA to compare both options and put you on the higher one, there is a real chance you've been leaving money on the table for years. Call SSA at 1-800-772-1213 and ask them to pull both figures and compare them directly. Bring both Social Security numbers when you call, and don't let them close the call until you have a clear answer on which benefit is actually larger. If you were divorced rather than widowed, a similar rule can still apply. If your marriage lasted 10 years or longer and you haven't remarried, you may be entitled to a benefit based on your ex-spouse's record and claiming it has zero effect on what they receive. Most people in this age group have never been told that. Now, here's something else specific to this window that very few people know about. Anyone born before January 2nd, 1954, was grandfathered into an old strategy called the restricted application, where you could collect a spousal benefit only while your own retirement benefit kept growing all the way to age 70. The youngest people in that group already turned 70 back in 2024. Here's the catch. The switch to the larger personal benefit isn't always automatic. Some people who set this up years ago never got moved over and are still collecting the smaller spousal check today. If this sounds like it could be you, that is worth a direct phone call to verify, because every month you spend on the wrong benefit is money you're not getting back. The second thing to check in this window involves Medicare, specifically a surcharge called IRMAA. The SSA determines who pays IRMAA based on the income reported 2 years prior, so for 2026 they're looking at your 2024 tax returns. If your income spiked in a past year, maybe you sold a property, cashed out an IRA, or had some other one-time bump, Medicare may still be charging you extra today based on that old, outdated number. In 2026, Part B premiums range from $202.90 to $689.90 per month, depending on income. There's a specific form built for exactly this situation. It's called the SSA 44, and it exists so that people whose income has dropped since that old tax return was filed can get the surcharge reduced or removed entirely. You can download it directly from ssa.gov or pick one up at any Social Security office. Life-changing events like a loss of income, death of a spouse, marriage, or divorce are qualifying reasons to appeal, and you have 60 days from receiving a notice to file. If your Part B premium is running higher than $202.90 a month right now, it is absolutely worth finding out why, because a successful appeal can put real money back in your pocket every single month. And even if IRMAA doesn't apply to you, it's worth asking your state Medicaid office whether you qualify for a Medicare savings program, since those programs can cover your Part B premium entirely if your income falls under certain limits, and almost nobody in this age group has been walked through what those limits actually are. Window 2. Born between 1955 and 1959. You're between 67 and 71 years old now, and honestly, this is the trickiest window of the three. Your full retirement age isn't a clean, round number like 66 or 67. It moves month by month depending on the exact year you were born, and most people in this group have never bothered to look up their own specific number. Born in 1955, your full retirement age is 66 years and 2 months. Born in 1956, it's 66 and 4 months. Born in 1957, 66 and 6 months. Born in 1958, 66 and 8 months. Born in 1959, 66 and 10 months. That number, down to the month, is the one that actually matters, not the rounded version most people carry around in their head. Here's why that precision matters so much right now. If you claimed early with the wrong assumption about your full retirement age, the damage is already permanent. Say your true full retirement age was 66 and 6 months, and you claimed at 62 anyway. Your benefit took a reduction of roughly 25.8%, and it stays reduced for the rest of your life. On a $2,000 monthly benefit, that's over $500 gone every single month, which adds up to well past $100,000 across a typical 20-year retirement. On the other side of that coin, if you're already past your full retirement age and still haven't filed, every month you continue to wait adds roughly 0.2% to your eventual monthly check permanently. That compounds out to about 8% a year all the way until age 70, meaning you could be sitting on a benefit worth 24 to 32% more than your baseline simply by holding off a little longer. And if you're in this window and still working while already collecting early, you need to understand the earnings test, because it trips people up constantly. In 2026, if you're under full retirement age for the entire year, you can earn up to $24,480 before Social Security starts withholding money. Once you cross that line, they take $1 back for every $2 you earn above it. Here's the part almost nobody tells you, that withheld money is not gone. It gets credited back to you as a higher monthly benefit once you actually reach full retirement age. But if nobody explains that up front, watching a chunk of your check disappear feels like something went terribly wrong, when really it's just the rule doing exactly what it's designed to do. We're about to get to window 3, and this is the one I mentioned at the top, the one with the change that has been genuinely blindsiding people this year. Stay with me. Window 3, born between 1960 and 1965. You're somewhere between 61 and 66 years old right now, and for every single person in this group, full retirement age is exactly 67. No month-by-month math required, which is one small piece of good news. What matters most right now is understanding exactly what claiming early costs you in real terms. File at 62 with a full retirement age of 67, and your monthly check drops by 30% permanently for life. On a $2,000 monthly benefit, that's $600 gone every single month, which works out to roughly $144,000 in cumulative losses over a 20-year retirement compared to simply waiting until 67. SSA will ask you directly whether you understand your benefit will be reduced. You'll say yes, and that reduced number becomes your permanent number from that point forward. There's also a claiming option. Almost nobody in this group knows exists. If you apply after you've already reached full retirement age, you can request up to 6 months of retroactive benefits paid out as a lump sum, effectively backdating your claim by half a year. On a $2,000 monthly benefit, that could mean a lump sum of up to $12,000 arriving with your very first check, with the trade-off being a slightly lower ongoing monthly amount going forward. And if you're still a few years out from claiming, the single most valuable thing you can do right now is pull your full earnings record. Go to ssa.gov, set up a My Social Security account if you don't already have one, and go line by line through every year on your statement. Compare it against your own W-2s, pay stubs, or old tax returns if you have them. One incorrect year, an employer who misreported your wages back in the 90s, a freelance stretch that never got logged correctly, can quietly shave around $100 a month off your eventual benefit for the rest of your life. Catch it now, while documentation is still easy to track down, rather than discovering it after you've already filed and the number is locked in. Now here's the thing I've been holding until this point, and it applies across all 3 windows, but it's hitting people hardest right now in 2026, and most people have absolutely no idea this happened. As of 2025 and heading into 2026, the default withholding rate for most Social Security beneficiaries is 50% of monthly benefits, a sharp reversal from both the prior 100% policy and the earlier 10% cap. Here's what that means in plain terms. Beneficiaries may owe the Social Security Administration money due to overpayments when their monthly benefit checks are more than what they are owed. These erroneous payments can happen for a variety of reasons, such as if a beneficiary fails to report a change in their circumstances, or if the agency does not process information promptly or enters errors in its data. And when SSA decides you were overpaid, even if it was their mistake entirely, they now have the authority to take 50% of your monthly check until the debt is cleared. Beneficiaries typically have 90 days to request a lower rate of withholding, a reconsideration, or a waiver of recovery. If they do not make such a request within that 90-day window, the agency will withhold up to 50% of their benefits until the full amount is recovered. Most people receiving an overpayment notice right now have no idea that window even exists, let alone that they can push back on it. You can request a waiver of repayment or a repayment rate below 50% for reasons of financial need. The form for requesting a lower rate is SSA 634. The form for requesting a full waiver, if the overpayment wasn't your fault and repayment would cause genuine hardship, is SSA 632BK. SSA will not volunteer either of those options to you. You have to ask, and you have to ask within that 90-day window, because once it closes, the withholding starts automatically. Since most errors are made by Social Security, and many people don't even realize they are being overpaid, taking 50% of benefits for months or even years until an overpayment is corrected could be absolutely devastating to a retiree's financial security and could occur through no fault of their own. If you receive one of these notices, do not set it aside. Read it carefully, note the date, and respond within 90 days. And one more thing before we wrap up. This one is specifically for anyone in Window 1 who lost a spouse. To trigger the lump sum death payment, the deceased individual must have been collecting Social Security retirement benefits based on their own work record. If a spouse did not accumulate enough lifetime work credits to qualify for Social Security independently and was instead receiving a spousal benefit tied entirely to their living partner's work history, the lump sum death benefit cannot be paid out to the survivor. The $255 amount was established in 1954 when Congress fixed it at 3 times the deceased's monthly benefit, up to $255. At the time, average benefits were around $85 a month. Subsequent legislation capped the benefit at $255 in 1981 and removed the formula entirely. The amount has never been indexed to inflation. So if you were denied that payment after losing a spouse of 30 or 40 years, the denial may have been legally correct, and it has been catching grieving widows and widowers completely off guard this year. It doesn't mean you're out of options on survivor benefits overall. It just means that specific $255 payment has a rule most people never knew existed. So here's the full picture. If you were born between 1943 and 1954, confirm you're collecting the right benefit, especially if you're widowed or divorced. Verify whether the restricted application switch happened correctly if it applied to you, and check whether IRMAA is overcharging you on Medicare based on income that no longer reflects your reality. If you were born between 1955 and 1959, know your exact full retirement age down to the month, understand what claiming early permanently costs you, and keep the earnings test in mind if you're still working. And if you were born between 1960 and 1965, understand precisely what a 30% permanent reduction looks like in real dollars before you file anything. Ask specifically about the 6-month retroactive lump sum if you're already past 67, and pull your earnings record while there's still time to fix any errors for free. None of this gets flagged for you automatically. Every single piece requires you to ask the right question, make the right phone call, or open the right document. SSA changes the policy and assumes you already know. This channel exists to close that gap before the mistake is already made. If this helped you find your window, drop a comment below and tell me which group you're in. It helps me know exactly what to cover next, and it helps other people in your group find this video. Hit subscribe if you haven't already, share this with someone in your family who falls into one of these 3 windows, and go watch the next video on this channel. There's a very good chance it covers something directly connected to what we just talked about, and the details in that one are just as important as the ones you heard today.